Hi everyone, this is Jason Burack of Wall Street for Main Street. I got listener requests for me to do a video about the stock market going down and having a correction and or crash. We won't know if it's a full crash until obviously in hindsight, or if we see, massive amounts of 20% down moves yet, which we haven't seen. So let's head to the charts for some technical analysis, just some really not sophisticated technical analysis. I'm looking at the S&P 500 ETF or SPY. Right now, this is a year-to-date chart. So we're down about 7% on that. You can see it looks like the cliff fell out here on my screen. High volume there on the downside compared to the other volume there. So that's a volume spike. Normally, volume is a big indicator, one of the leading ones on technical analysis. So if the volume normally confirms the move up or down, it's normally a good thing for the chartists out there, for the TA people. So this is a sign that the stock markets now are in a downtrend. Obviously, the plunge protection team, the Federal Reserve, whoever else is, trying to change sentiment and paint the charts and stuff, is fighting now the trend. They're fighting the trend now. So let's year to date we're down. Year to date we're down 7%. Let's see here. Let's go 6 months. 6 months on the S&P, we're only down around 10% still, and on the Dow we're down 6 months from the last in the 6 months. We're also down around 12.5%, and similar chart on the Dow here for 6 months, and this is the year-to-date one. See, cliff diving on high volume. So we're definitely in the potential for a really nasty bear market now in stocks. Obviously, you guys know I was saying the stock market was rising not on any fundamental reasons. The PE ratios were artificially low due to share buybacks and other things. Whether you listen to our most recent guest, Michael Leibowitz, or others, there was a lot of reasons why the stock market was going higher, either flight capital leaving China or so many other developing countries and coming into the U.S. because it was viewed as safer haven. The dollar and treasuries and the U.S. stock market was viewed as safer than the developing world. And now it looks like, we've, similar to 1929 and other areas when flight capital came to the U.S., and the U.S. was the last market to crash when there was worldwide depression. Then it seems that now, we're having similar type of correction now. The question, a similar type of correction where, there is no place to run, no place to hide, except for maybe physical gold or cash if you're out of the system and things like that. There's very little things right now that are still going up. In terms of the wealth effect, though, the Fed has routinely said for over a decade now, they've paid academic economists, these PhD Keynesians at the top universities, they pay them, over $100,000 per year in grants, and the documentary Inside Job, which won an Oscar for this, revealed this. This was something telling to me at the time. I didn't know that this was happening. So they had been paying for studies that talking about the benefits of the wealth effect and how it helps the economy and the consumer and all these other things. So it'll be interesting to see if the Fed sticks to their guns and does try to stick with the wealth effect at some point. The Fed is going to probably blink at some point. We're obviously having some type of correction or free market forces now. We'll see how much of a correction or crash the Federal Reserve and other global central banks allow. Now, we've seen China try to do all kinds of things to stop their market crash, and they haven't been able to do that, but the Federal Reserve does have other ammunition. So the question, even though people on the mainstream media are claiming the Fed doesn't have ammunition, but in a paper fiat currency system, what's to stop the Fed from doing $200 billion a month in QE or $250 billion a month for something like that to at least move the asset prices higher for a bunch of reasons. So my question then is the Federal Reserve then going to allow a 20% market correction? Is it going to allow a 40% market correction? Is it going to allow a 60% market correction or an 80% market correction? I don't think they'll allow an 80%. We just don't know, though, if they're going to allow 20, 40, 60, any of these numbers. I think in terms of probability and betting, we've already had, depending upon which index you look at, whether the Dow or the S&P, we've already had between 9 and 12% already of a correction, and the downtrend is now established. So we're going to go lower, at least for a while in the short term. So I think 20% correction at least is a very good bet. So if you are out there buying puts, you're not going to be able to buy them as cheap as you were a couple weeks or a month or two ago, like some other people were predicting. But it's not too late if you're an options trader and things like that. Now, options trading is sophisticated, so I mean, there's a lot of different stuff that you need to know for that. What price are you paying for the option? How much time are you giving yourself to let it play out, and things. But it's really interesting though to guess on how long the Federal Reserve, because they're Keynesians, they do not like the free market really at all. They really don't. Is how much of a market correction are they going to allow before they do something? Now, Jim Rickards, I personally think it's going to probably be 6 to 12 months. They're going to allow this to go on. And, guys, it's all probability. Nothing is guaranteed here. So, we could have a 40% correction. That's probably fairly high probability that we may have between 20 and 40% correction. Now, 60 to 80, I'm not sure the Federal Reserve is going to allow that before they start doing something else. There's going to be pressure from the politicians. There's going to be pressure from the banks. There's going to be, pressure. Everyone's going to be pressuring them to go back in there. And it would be intellectually dishonest for them if they just abandon the wealth effect, especially when for more than the last 10 years, the Alan Greenspan Fed, the Ben Bernanke Fed have been paying so many different people to write research reports to find, these one little piece of data points here when most of the data points say that the wealth effect doesn't work at all, that to grasping at straws to find a few of them that say it does. So we'll see if they pretend that they never said the stuff about the wealth effect or not, but we'll just have to wait and see. But Jim Rickards on his Twitter recently has said that the Federal Reserve doesn't care about stock markets really for the most part. They only care about making sure the banks are capitalized. Now, I'm not fully sure I agree with this. Obviously, the banks take precedent because the Federal Reserve is a cartel for the largest member banks who are the main shareholders of the Federal Reserve at this point, or one of the largest groups of shareholders of the Federal Reserve at this point. But the question then goes back to the wealth effect, because for the last 12 years, like I said, the Alan Greenspan Fed, the Ben Bernanke Fed have been paying people to put out these research reports talking about the wealth effect, even before Janet Yellen was sworn in to be the Federal Reserve chairperson. She even said how good the wealth effect was for the poor and things like that. I mean, obviously a lot of people were laughing at that, but she actually seemed to believe it. Maybe she was just acting really well for the cameras, but who knows? So we'll have to see on that. But one thing is for sure, guys, is that all stock markets now are manipulated, and I think there's massive amounts of data points doing that, and also these charges that we're seeing. So whether it's the large banks getting busted for LIBOR, or the large banks, 5 of the large banks being busted for manipulating currencies, they manipulated electricity prices, they manipulated many different commodity markets. The evidence is just overwhelming, but we never hear any of the mainstream media talk about this. So welcome to dystopia, guys. It's just kind of ridiculous now. We don't really have a free market. We have a free market in the fact that maybe for the next, couple months, they're going to allow a market crash because the fundamentals never justified the stock market to get that high. But that they're not going to allow permanent free market forces. The Keynesians, the interventionists, the central planners, the politicians, that these guys' interests are all tied to saying, oh, look, the stock market's going higher. Oh, look, all our economic numbers are so good. Even when all the economic numbers, whether it's China or Japan, the United States or Europe, are all totally bogus. They're cherry picking data. There was the scandal with the Obama administration, how before a second re-election, how the Department of Labor employee for the New York Post reported this, a whistleblower. He admitted, all the employment data was falsified to make the jobs numbers look good so Obama could get reelected. There's so many examples I can name of, all the data points that are stupid. I mean, the Chapwood Inflation Index, we had Ed Butowski on, and he says in the United States, in most major cities, the inflation rate, when you count all the property taxes and all these other taxes that go up every single year, in addition to rents going up and food prices and things like that, the inflation rate is double digits for the last 4 years or so for most of the major cities in the United States. But, most people, if they notice prices are going up, they're going to blame the evil, greedy corporations. They're not going to blame the Federal Reserve and politicians for jacking the cost of living going up. So welcome to dystopia, guys. It's just crazy, all this stuff going on. I don't think anyone out there in their right mind really knows for sure how long. I mean, we could go back here and look at the charts here on the max chart here and maybe guess where the next major support level is. I mean, the next major support could be down there at 2011. That's not super major support level though. It could be there from 2007. It could go down quite a bit further, guys. We could go down quite a bit here. But I mean, there was no real justification fundamentally for the stock market to go as high as it did after 2009 when it almost doubled. I mean, that was an enormous amount of inflation in the asset markets that the Keynesians, the people in the mainstream didn't count, the people on Wall Street didn't count as inflation. So that all that wealth effect money it lined their pocket didn't really help the people on Main Street that much. Maybe a little bit in their 401ks or IRAs, or their property values maybe went up a little bit. But I mean, that's not really helping most of them, because most people are that we speak to on Main Street are barely getting by, and their bills are going up. And that's despite the oil price crashing and things like that. Another thing I want to confirm, that the economy is not doing well, and people say the oil price, but I think the copper price is more indicative of that, and we just have had a massive amount of oversupply and overcapacity in the copper market, really for a number of years now. There may be, now I don't think anything's guaranteed, but there may be 10 years or more of oversupply, overcapacity for copper in the market. Goldman Sachs says there's a copper shortage, but almost all the demand that was in the copper market, and China was over 50% of demand in the copper market, it was from central planning, guys. So the Chinese were eventually probably planning on building all these buildings and things. The private sector might have built some of these buildings, but they weren't going to build all these buildings at once and things like that. So this was all central planning demand that was just moved forward from Keynesian economics and mercantilism and central planning. And, all these higher marginal, higher cost producing copper mines were brought online that needed $3.50 or higher copper. So that's why for the last 2 years, give or take the last 2 years, I was saying the copper price was going, when it was way above $3 a pound still, surprisingly, that it was going to crash. I was very confident about that. I thought we would see $2.30, $2.40 copper a pound for sure. Couldn't give you an exact time frame on that. I may have been a little bit early on that with my call a couple years ago, but it's playing out pretty right. I think now for copper, guys, unless we see a lot of mines close, and we haven't seen that yet, we're going to see copper, go in a really low trading range. Maybe it might even go below $2 a pound for a little while, and then we're going to start to see the mine shut off, and we're going to see a really, a low and wide trading range from maybe $2 a pound to $2.30, $2.40 a pound for at least a couple years, in my opinion. Because I don't think copper is that good of an inflation hedge because of how much extra supply has been brought online. Now, maybe, if all these fiat currencies and the race to debase, if all these currencies do start massively hyperinflating, then, copper would probably be smarter to hold copper than paper fiat, than all paper fiat or digital dollars or things like that, or other fiat currencies that are being hyperinflated, whether it's the yen or the euro or the RMB or so many other of these currencies. And Kyle Bass has I think he's storing a whole bunch of copper pennies, and he got I think he bought $1 million worth of copper pennies, or he wanted change, and then he moved them into a vault. So it's just really funny. But we have so much crazy things going on behind the scenes, guys, and the U.S. mainstream media isn't really reporting on this either. We have mass amounts of oil market manipulation too. I had on Kent Moores recently in the last couple weeks, and he said OPEC sovereign wealth funds were actively shorting oil to knock it down. I guess there's a type of coordinated game plan, and if you read the newspapers outside of the United States, like the ones in Al Jazeera or so many other different sources outside the United States, they're citing sources from within the Saudi government and OPEC ministers and things like that are saying that the Saudis want to bankrupt the U.S. shale oil producers and other higher cost producers to regain market share. So this is kind of like in Game of Thrones, how like the people who are kings now, they don't want any successors taking them over, taking their throne, or ruining them. So they're trying to look for ways to take them out. So the Saudis, because they have the lowest production cost and they have so much cash flow, and they had over $700 billion in reserves, and now they've spent $65 billion in reserves because of the low oil price, and they've also taken on a number of $1 billion in debt to buy themselves time, because they've promised a lot of social program money, and they can't pay off all those bills with this low oil price. The Saudis are now playing a very dangerous game, where they think that because their production costs are so low and because they're well capitalized, they think that they can put the shale oil companies who have a lot of debt, high production costs, either they hedged for a shorter amount of time or didn't hedge at all. They think that they can put these guys out of business because these guys can't get raise the capital for debt and equity to survive like the Saudis can. So the question is then, are the banks, are the Federal Reserve, are they going to, be able to give the shale oil producers the capital they need to survive? I don't know. I think we've already seen a small amount of bankruptcies in the shale oil producers, but the Saudis said, they're only doing this for a short-term move. I don't know what they define as short-term, but, they see this as a long-term positive for a higher oil price and for more market share and stuff like that. So Kent Morris thinks that they can maybe do this for a few more months. I spoke with Eric Dubin of Welcome to Dystopia and the News Doctors, and he was running the numbers with the Saudis, and he thinks they could do this for a couple years. I don't know if we'll see the Saudis do this for a couple years, though. That would put a lot of debt burden on them, but you never know in these markets, guys. I mean, this is crazy, though. We have governments, like, either covertly or overtly just directly going into many of these large major markets now, and just, whether it's with high frequency trading algorithms on the gold and silver paper price, or hiring Wall Street maybe to short an extra commodities market more, or having your sovereign wealth fund manipulate a market. It's becoming really crazy with all the market manipulations going on behind the scenes. And that's why I have a few friends who are business people, but they don't pay a lot of attention to markets. A lot of them are in all cash right now, or they've been for the last year or two, because, they see all these volatility swings, and they see, all these negative headlines and things like that, and the market's still going up, and they're scratching their head, and they see the valuations on the stocks, and they don't want to pay them, so they were just sitting in cash. But in terms of the oil market, guys, ExxonMobil, Chevron, ExxonMobil, the valuation-wise, they may cut the dividend, I don't know. Everything's probability. There's no guarantee they fully cut the dividend or anything. But, this is the cheapest ExxonMobil has been in 7 or 8 years since 2007 and the year 2000. So, the goal of investing in the long term is to buy low and sell high. So I don't think ExxonMobil is going to go out of business. Maybe they cut the dividend a certain amount. Maybe they cut all the dividend temporarily, but they didn't cut the dividend in 2008 when oil prices crashed too. So we'll try to have some more oil people on to keep you guys up to date on that and what they think of the dividends. But, I don't think it's sustainable how much lower the oil market can go, because a lot of the unconventional oil producers, they can't raise any money now in this environment. We're starting to see mergers and acquisitions, whether it's Schlumberger recently putting in a buyout bid for Cameron International, and we're starting to see other buyout bids and takeovers and things like that, and smaller, higher cost, debt-ridden companies go bankrupt. We've seen that to a larger extent. We've seen that also to a smaller extent in gold and silver. The safe gold stocks right now, the ones in the driver's seat, the ones I think are very safe, are the royalty and streaming companies. These guys do not need debt to grow. So they are Franco-Nevada, Royal Gold, Sandstorm Gold, Silver Wheaton, Osisko Royalty Company. Smaller one is Orico Metals, but it'll probably be taken out. It was a spinoff. I don't know if Sandstorm Gold will buy it, but maybe someone else will come in and buy it. They have a couple pretty good royalties on the books there, but there should be more of these companies, and these guys have capital right now, and they don't need debt to grow, and there's not a lot of capital available other than from Sprott and the royalty and streaming companies and private equity at really penalty terms for the gold and silver companies, and yet we see demand for gold and silver for the actual physical metal very strong. So, eventually what we're going to see, guys, though, is all this volatility that is happening in global markets, whether it's a Chinese exchange that's collapsed with China trying to intervene and penalize short sellers, which is ridiculous and interventionist and non-free market, or, so many other markets having mass amounts of volatility now, and the volatility was intentionally, suppressed for a number of years. This volatility, a lot of people cannot stand or stomach the volatility. We are going to see more people, maybe in the West, who bought gold in 2008 and 2009, and then sold gold maybe in 2011 or 2012 because they said, the world's not going to end now, I don't need gold anymore. And that's what people in the West did with their physical gold and silver, most of them, unfortunately. We may see them start to go back into gold and silver again, but those are not the strong hands. Or maybe if they do see markets completely crash further, maybe they will become more strong hands or start to wake up to all the stuff that the politicians and the central banks and the other crony capitalists and the corrupt political parties have done to the economy, the raping and pillaging of the U.S. taxpayer and the middle class. I'm going on a long rant here, guys. Well, anyways, though, guys, I think, in terms of deals in the stock market, a low oil price does not help a lot of the other energy companies, except solar is being subsidized right now, although, people are claiming, solar is economic without any subsidies, but I'll believe it when I see it. But a low oil price is not good for funding for many other energy alternatives, except maybe natural gas. So this is going to be very interesting here. I think we may see copper go lower. With the Chinese RMB devaluations, I think we're going to see some type of currency war restart with the other Asian economies. So whether that's Japan or South Korea, Thailand, so many of these other Asian economies, they're all Keynesians. I mean, where did these guys learn how to do their central banking? They learned in the United States and London. They learned from the Keynesian economists in those countries. Some of them may have worked on Wall Street, or the Keynesians on Wall Street, and they learned there. So, I mean, these guys are all playing from pretty much the same playbook. It's all Keynesian economics and central planning, and Keynesian economics comes from mercantilism and is a lighter version of a lot of the same. Keynes agreed with a lot of the same stuff that Marx did for the most part. If you don't believe me on that, go read Henry Hazlitt's book, Failure of the New Economics, and he goes through line by line of Keynes's general theory, and he shows that, Keynes agreed with Marx on a good number of stuff, including the labor theory of value, where wages can't be allowed to fall, and so many other different things. If you guys have any other questions, just shoot us an email, wallstreetformainstreet@gmail.com. We're almost to 1 million views. I think we're over 950,000 now, so only 50,000 left. We'll get that done in the next couple weeks. And if you guys bought puts on the stock market already, congratulations. If you guys didn't buy puts yet on the general stock market indices, it's not too late, because I think the downtrend is still established, but you're not going to get the puts cheap. So if you have any questions about buying puts or want some education on options or puts, you can shoot us an email, and maybe we're available for paid consulting work and sessions and things like that. But it's not easy money on an easy trade anymore, and it's not cheap options like it was a number of months ago. So congratulations to the people if you made like over 100% or 200% on buying your puts already on the general stock market index. You may want to take a little bit of money off the table so you get some of your capital back. Don't sell all of it, because I think we're gonna have more of a downtrend, because it looks like downtrend established. And then the question is, guys, it's all probability, nothing's guaranteed. How much pain is the Federal Reserve going to allow? How much pain are they going to allow before the politicians and the Wall Street guys and the hedge fund managers and the pension fund managers and the other people that all needed higher stock prices start bitching to them and telling them, you know what, you can't allow any more of this? Because the Fed's, it's not independent. It claims to be independent. It's not independent. It's turned into basically like a bunch of politicians, and they listen to lobbying and things like that. So thank you for watching this video. We're going to keep cranking out the quality content, and we're going to do our best to cover all this for you guys with the Austrian School of Free Market Economic lens. And, even though the stock market and things like that are declining, they call this deflationary asset price deflation. I don't see my taxes dropping. I don't see my bills dropping. Even the gasoline price hasn't really dropped. So maybe that's a little delayed. But, where's this deflation? I want beneficial deflation. I want my purchasing power increase. I want my taxes to drop. I want deflation, but I am really not confident that the people in power are going to allow real deflation for a long period of time without basically destroying the currencies first.